Hello and welcome once again to Tuesdays with Lloyd's. Today we kick off the first in a special 3-day series with a focus on U.S. Casualty. My name is Pat Talley, Regional Director and Managing Agent Practice Group Leader for Lloyd's in the U.S. These are 3 consecutive short, punchy sessions today, tomorrow, and Thursday. So without further delay, let's just kick right off by introducing our panelists. Alexandra Littlejohn with Alliant, Matthew Yeldham with AEGIS London, and Paul Bland from Aspen. And with that, since we're on a short schedule today, let's just turn it over to our guests and the floor is yours.
Thanks, Pat. And thanks, Lloyd's, for inviting me to participate, moderate this panel with my great friends and colleagues. Moderate, we're going to use that term loosely because moderating Paul and Matt is a forever challenge, but I'm going to give it a best go. So let's dive right into things, guys. I think we should hit it hard on the things that are topical that we're all very concerned about, that we know our clients are concerned about. So let's dive in. Nuclear verdicts, social media, reptile theory. Let's have that conversation. Let's talk a little bit about that, and we can dive deeper as we go.
Matt, do you want to start?
So yeah, I suppose first thing I'd sort of say is that we spoke about all of this in advance of how we would sort of try and approach this sort of subject, and we were thinking that we've got to be blunt about it and actually put stuff on the table that people will find interesting and actually find of use. And there's no point in sugarcoating stuff, but we are in both as insurance buyers and insurance writers and also insurance brokers, we are in a very, very challenging environment in terms of what we're dealing with here. Awards just keep getting bigger and bigger, and so on and so on. And we are confronted with one of the most aggressive, warlike sort of plaintiff bars one could imagine, who are incredibly, I suppose, inventive, and are pushing all sorts of buttons to get the biggest possible numbers. And frankly, for their own benefit, if I was being really cynical. So I would sort of say that to begin with, just to sort of give a bit of context about why we're talking about this today.
Yeah, and I'll chime in on that. I'm sure a lot of you see a lot of things that make headlines, and those nuclear verdicts make headline grabbing numbers. And that's the stuff that is out in the general press and hitting the headlines. And obviously we're not just seeing it at that level, we're seeing it a lot more frequently, which we shouldn't, especially if you're writing excess casualty business. So yeah, there's a lot of noise out there, which we also think coming out of a pandemic and coming out to business as normal and the tort environment unpausing itself, there's a lot of unknowns out there.
So why is this the case? We can sort of speculate as to why society has sort of moved towards greater abilities to sort of come up with massive awards. There's almost been a desensitization to huge amounts. People sort of, jokingly say that it's the sort of the growth of the contactless credit card. You don't sort of see money being handed out as such. However, I do think there is something in the fact that the reptile theory has been espoused enormously, and it has created a sense amongst juries that it's not a question of forensic damages in terms of liability in respect of a particular accident. It is rather that a narrative is created by the plaintiff's bar that the insured, the defendant, if you will, is on trial for their crimes against humanity / society in inverted commas, and the award and or the settlement is punitive in that respect. And it's important that people understand this, and this is what is giving rise to this runaway inflation.
Well, I mean, just to challenge that for a second, I think we get that it's been going on. How do we mitigate it? Social media is the worst invention made, because it truly puts everything in the moment, on the moment. I mean, we're thankful for it today, of course, but for for a claim or an insured who is trying to defend themselves, how do we go about it? Tort reform seems super far away and almost not even the issue when juries are really the ones barely listening to the rules of the road. How do we combat those effects? How do we stop that? How do we look at some kind of maybe non-court track settlements before you're going into the jury pool? Is there a change up in the jury pool now that we're done sort of or past the pandemic? Where are we from what can we do? What, in your expert opinion, Paul and Matt, can we do to help advise?
So I'm not a huge exponent of social media. However, I do think that companies who have a certain amount of discipline over their employees' use of social media do certainly do better. The less stuff that you have out there that is damaging and detrimental to your image as a corporation is important. So you really have got to sort of have as much control as you possibly can in terms of that as an issue. Paul?
Yeah, I agree with you, Matt. I think the concept of discovery to a lot of people is unless you're a lawyer or you do what we do, that people really do use email, social media as this echo chamber that once it's out there, it's out there. So you can't take it back. And of course, we're seeing that at the moment where, with things like climate change litigation, we know that plaintiffs' counsel are doing all this discovery to find that smoking gun that they know that is out there. And they are pretty positive it is because someone has made a comment and they're just looking for that one hook. I think that it's always difficult because, of course, we have relied on email, social media, especially in this way of working coming out of a global pandemic. And of course, we're not going to sit here and go, that's it, we're done. There's changes in flexible working. We've got new ways of not new ways, more established ways of communicating. And as of course, that leaves sort of an electronic trail. And of course, I think what we're seeing with a lot of in defending claims is there's that one bit of information out there that it could look as something quite flippant or as an off-the-cuff comment or something that suddenly comes back to bite, and be it whatever side, it can come back and haunt, which is very difficult. And it's interesting just seeing already a question in the chat about how do you deal with defense costs and all that sort of thing. I think unfortunately, when you're underwriting lower layers where you're just sitting there going, well, hang on here, is my layer going to go on the back of defense costs? Then it's, you do get that sort of misalignment with certain people who probably say, well, I will just be cutting a check to a law firm and then the indemnity will come above us per se, depending on how programs are structured.
And lawyers are lawyers. Lawyers
Yes,
are lawyers, and lawyers
absolutely,
will look to sort of spend money. But in some respects, some of what they say and advise is good, and the use of mock juries can be a useful tool to ascertain where you are in respect of a particular case, and certainly get a sense of the potential damages and the award that you may be talking about. So I suppose, takeaway there is make sure people don't post silly stuff that's going to hurt you as a defendant, and pick decent counsel and be prepared to, invest in mock juries and work out what stuff's potentially worth.
I think it's interesting my view. To say that, Matt, is that we do see in certain cases that some people just want to walk away, or they use the insurance product as a brand protection tool, as in it gives a certain, not just coverage, but on the defense costs, and just, we've seen in a couple of quite high profile cases where it's been done under closed doors, and then as said, insured will just say, hey, we've settled it, and by the way, because it's all under non-disclosure agreements, where's our check? Now, that's not a great way to handle things either. And it also, you turn around and sit there and go, because of the costs or whatever associated, then you do sort of change your view on how you underwrite certain things, if that's how it's going to be. But yeah, there's a lot in the mix there, definitely.
And I'd also say, my firm belief is that there should be a collaborative approach between buyer and seller in terms of the liability product and how cases are handled. Underwriters do want to work together, with clients in terms of defending stuff. If it's done, separately without levels of communication and collaboration, you are not going to get as decent an outcome.
And we had one of our guests asked a question regarding this between the social inflation cost between large accounts and small to medium big client companies. do you see a difference? I mean, I have an opinion on that, but I'll let you go first. I feel that there is a difference, but I'll give it to you both
I think
first.
I think it depends. I mean, Matt and myself in the Lloyd's market get involved with, one band, two band contractors, for example, and the Fortune 100.
Right.
So, when you're dealing with the larger companies who have got, they know their product or they know their service and they've got very large corporate legal functions and compliance functions, then that is a completely different animal to a guy who's, say, a scaffolder in New York, for example. So I think our job and the product we supply is to differentiate between the two and what the approach is. But that's where the value of what we bring in, not just as Lloyd's underwriters, but I think anybody writing US primary and excess casualty business comes in. And also, I think it's part of the evaluation of what you sit there and how you align yourself with clients. I think the alignment is pretty key and very interesting, especially on how, if something's been done in the past, we don't, I get it. Underwriters do always look over their shoulders and very much are, looking backwards as a key to see what's the indicator. And I do think, we've seen some, pretty tough and high value claims, which have been very well handled by clients of certain sizes. And I think that's where the proof of the pudding is there. And that's where we sit there. And I think especially Lloyd's underwriters do align themselves more on that, because we do work with clients and to get what we think is the outcome. We don't run away. And I do think that is quite important when you're selecting, with anything. It's how the proof of the pudding is in that eating, as far as I can see. It's how things get handled in that.
I think it varies enormously, and we've seen claims be handled different ways by certain clients. If I was going to say something, I would say that some clients probably look at liability on a different basis, and they look at it much more in terms of brand protection and to protect their reputation, as opposed to the actual and sort of reasonable and forensic damages in terms of any particular case, in terms of medicals, loss of earnings, and so on and so on. Whereas some clients look at it much more specifically. If you're a larger insured, it probably is, there's probably a greater temptation to think that way, but lots of the smaller insureds, it becomes an existential issue for them as a company. If there is going to be a concern that they could go through insurance limits and to be into the assets of the company, which brings me on to the sort of the next point, is that people need to think about what level of limits they're buying. And there are different schools of thought. And Alex, I'm sure you've got views in terms of what, people should look to buy and how much. But there are all sorts of things to bear in mind: D&O, peer groups, and so on and so on.
Yeah, I mean, I think the former question, I think size doesn't matter, but words matter, because I think in the end you can be a moderate to small, medium-sized business and suffer a loss, hopefully leading to your point on limits available, just as easily as a large Fortune 500 or 100 company. But it matters, I think, in how the words and the intent of the policies are written. And I think that sometimes, the more off-the-shelf policies don't take into account the major issues that even a smaller or mid-sized company could have. So every risk is different, and every risk should have words that match their exposures, so that when that claim does occur, we've got some certainty that the policy is going to pay. From a limits perspective, it's something I've never seen before, in how much limit fluctuation has happened. Obviously, in the hard market, we've been forced in certain instances. Our clients have been forced in certain instances to not be able to buy as much limit as they previously have bought, maybe because of the cost, maybe because of exposures or coverages that they need or they can't get. But there's been just this wide varying of limits that have either retracted or, in certain cases, opportunistic and bought more. I hope to hear that and feel that that's settling itself down a little bit, and that we can start to be a little bit more stable as it relates to capacity, and for those that
But
lost capacity, buy more back.
But it's an interesting question. So if you have an insured who has, say, bought 500 million every year, and then they choose not to buy that same stretch and they only buy 400 million, and the different, but they could have bought 500, but for a difference in cost. And then they're unlucky enough to have a situation where there is a big claim, and potentially shareholders are then going to look at the situation and go, hey, well, you chose not to buy that extra 100 for the sake of X, but that's cost us 100 million.
Yeah,
It's a genuine consideration.
It's a real consideration, absolutely. And I think that we as brokers, clients, we're all talking about what is, where is that right, reasonable, purchase of insurance and its efficiency versus assuming that risk. And lopping off the top isn't always the answer. Contributing to the risk down low isn't always the answer. It's one of the toughest questions over the last couple of years. If we narrow down a little bit, just because I think the audience wants to hear, we had a couple of questions with regard to construction, and auto, two of the hottest topics, certainly in the United States, and obviously we can narrow it down even more into geographic areas within the United States. But auto is an issue no matter where you go. Short haul, over the road, it's an issue, obviously. And then we've got all these social things that have become more acceptable forms. So in the United States, the majority of states have legalized marijuana. How is that an impact? How has that become an impact? Is it an emerging trend? Is it something that we're concerned about, that you would be concerned about? Because it's different than the let's go down to the Lamb and have a pint, after work, which I hope still happens, because I'm going to come and join you for that. But, this sits in your system for a little bit, right? It hangs in there, and you go home, you do things, you get hurt, you're injured, you injure another party. Is there a responsibility back to the employer? There's just 1,000 little questions in that I'm throwing out at all that you both.
That's quite hard to underwrite, especially because what was interesting is there was an article in the New York Times, I think, at some point at the end of last year, that actually talked about how with less vehicles and autos on the road, the incident rates are going up. Interestingly, because of people haven't been. It's a skill, of course. Driving, it's not a given, and of course, if you haven't been driving for a while because you've been furloughed at home or not needing to go into the office, then and the same with if you're a truck driver and you've been not doing as much, then that's out there as well. And then you put on top of the fact that certain things that were socially unacceptable because they were illegal are now socially acceptable because it's now legal for marijuana, for example, being as a medical use and recreation at times. So yeah, it is very difficult because we do sit there and go, this, we've got a lot of data, there are a lot of companies that do very well that we know have got tons of data and are able to manipulate and move very quickly and on how they underwrite the product. But it is difficult because it's an ever-changing landscape that quite often that we just, it's hard to get on the front foot and get your head around.
But the optics of any particular situation, any claim situation, are that if someone responsible for the accident is under the influence of in any way, shape or form, or they are less able to operate as well as they should do because of drugs and alcohol, that is not a good situation. And the optics of it are going to lead to a greater challenge in terms of potential damages. And the plaintiff's bar will be very, very quick to latch onto that. So I would, advise insureds to make sure that, they are promoting sort of safe environments, working environments, and also that there is no sort of sense of any of these corporations promoting a drinking or irresponsible culture in terms of their workforce.
I think on top of that, Matt, there's been a lot of development in those sort of risk management strategies, haven't there, with telematics and the way that a lot of the clients that we all see are sitting there doing a lot of things to try and get ahead of this. And, when you're, I always say, I think we've said a number of times, I know on various things that Matt and I have done with the RIMS Academy and Lloyd's, is that if you give us data and can prove you can differentiate, then you get a more valuable, I think an underwriter would consider you more. And if you differentiate yourself from the norm, when you're sort of imparting to underwriters what makes you different to your peers, or the fact that there are certain risk management strategies that you've invested and put in that actually show your incident rates have gone down, even though we know in certain areas that we know, especially in Texas, for example, where there's been some runaway verdicts and the like. But we get that, we know that as a risk transfer process, we're here to do what we're here to do. But in terms of, as you say, managing your messages upwards to CFOs, because a lot of risk management departments are in that function, that corporate finance function, and sort of say there's a reason why, if we invest in the risk management, the insurance piece is also it also comes alongside that, and good underwriters, I think, should and would consider that when looking at their risks.
I can see a few questions about, there's not a question on ESG here. And I can see discussions about social inflation and general claims inflation. If I was just to sort of pick up one of those, the social inflation and claims inflation, I think there is huge amounts of overlap there. But what I will say is that, we are using a significant claims inflation factor from a pricing and or reserving perspective. So I think, call it what you will, in many ways you end up in the same place. Exactly. Yeah. On the ESG thing, it's still a very nascent sort of concept, and lots of corporations have not established fully developed ESG frameworks, but we are very much looking at corporations as to whether they are good citizens of society and they're actually doing the right thing. And it's certainly a conversation you can't ignore.
That comes into the moral hazard aspect of what we do.
Yeah.
I think, we wouldn't sit there and know, a known polluter that Hollywood then turns into a film, because we do see a lot of recent films made into certain issues that have affected our industry, probably a little too much as of late. So the moral hazard issue is probably an ESG. It's not a revolutionary thing. Where there's a lot of clients, to give them credit, have been talking about all these sort of the principles for a good 10, 15 years at least in certain areas. So, but does it factor, as Matt says? Absolutely, it really does.
Yeah. And just just from a planning perspective, so I think all of us work very hard to make sure that our clients are armed with as much information to present the best possible story. And they want to avoid surprises. They want to be prepared for their management and questions or boards or whomever they have to present to. If there were three things that, a risk manager or a broker could advise their risk manager to prepare for as they enter into their, excess casualty renewal, what would those three things be?
Well,
and maybe
I think first of all,
but I'll give you three.
I think first of all, I'd say is get ahead of it. Make sure you prepare early and make sure that you are managing upwards, and that the various stakeholders you are dealing with as the person responsible for the purchase of insurance in a corporation, that whoever you're reporting to knows what's going on, are educated and understand the pressures that you're under. Because the trouble is, there's lots of people who don't deal with insurance every day. They see it as an expense and an inconvenience, but trust me, it's a serious issue, and it can be existential, as I said, in terms of any particular situation. And the last thing you want then is the sort of the CFO or the CEO on the warpath to you saying that hey, you didn't tell me about this or that. So a problem shared is a problem halved, is what I would say to lots of people.
Oh, I mean, Matt, you're right. I know that sounds basic, but we've said many times about how many people we don't see that do that. But I get it. In certain companies, we see it's painfully obvious when we do meet a lot. And we're very fortunate. We see a lot of clients, both in London and in the US, who do not manage their message to the people that matter. I mean, And
Yeah,
you know,
and
you can't
surprises are
writer
horrible.
or broker when we're
Yeah.
sitting there trying to, you know, we're trying to come up with a solution and assist on some pretty tough areas that we've been talking about.
So next, I'd say probably think about the information you're presenting to underwriters. Underwriters, speaking as underwriter, you know, it's all very well sort of seeing a 10K sort of, you know, comparison, or, you know, from an investor perspective. But, you know, we're underwriters, we're not very clever. We're here to actually look at the risk. We're here to try and sort of make judgments in that respect. And so treating us as though we're investors is probably missing the point. So think about what underwriters need to see in terms of information, and try and present it in the most understandable format possible. Make it user friendly, stuff that is just indecipherable in terms of various Excel spreadsheets and so on and so on. And the, you know, very often the sort of the indecipherable Accord applications, which don't always make much sense. So I would, that would be my next piece of advice.
I'll piggyback on your comment there, Matt. I get it. There's no one size fits all, but we can always have too little, or we suddenly have so much that we suddenly start, you know, we can sit there, and if we have to trawl through a lot of what we deem superfluous data on that, say financials as 10K is a classic example, then you're not, it's you're going to have your point of view is going to be a bit different. But there's no one size fits all, which is why more often than not, the people that do present good data, it's because we do value, you know, targeted information. We get a ton of value of meeting people. You know, that hour meeting is, or whichever is so valuable. And obviously the broker's involvement in making sure that we, you know, I don't think underwriters should ask a ton of questions. You know, more often than I know, I ask a handful of questions which tend to be clarifications. But where clients are presenting complex risk, a meeting where we can sit and literally have a good conversation is so valuable. It really is.
I think the next point I would make is that clients should want to meet not just the underwriting function of any particular business, but they should want to meet the claims function, because really that is the shop window of what we're selling. And if there is not a, you know, competent and functioning claims operation within an underwriting business, you know what you're buying. And you've got to understand the philosophy of the claims people, their willingness to engage in discussion, their willingness to sort of help defend, offer advice, how they see settlements, and so on and so on. So I would really make sure that you try and at least develop some relationships with claims people.
I agree. I think that that's overlooked often. And yet when the claim happens, especially in excess casualty, it's large, it's catastrophic, it's going to be impactful. And you know, I know there was one of the last questions that we had on here was all about you know, the words. And I think they, again, I'll say they matter, making sure you're matching the exposure up to what you're insuring, so that when meeting that claims team, their intent is to pay the claim when it happens.
Alex,
so
I
think we only have a couple minutes left. So I'm gonna throw this one out to you guys. You know, where in the world is excess casualty going next? I mean, we've had this roller coaster ride over the last 3 years. Insureds have had to take assumption of risk into their captives, or, you know, just assuming the risk, and, you know, maybe that's short-term, long-term, but what are the effects? So just give me a 1 minute each outlook, or 30 seconds probably, outlook on where do you see it going? What should we look forward to?
I think
on Blandy, you go.
Yeah, I do think that, you know, I do think whilst it's easy to sit and reflect on things that, you know, and be pessimistic, but that's what casualty guys do. But I think from a product that we do, I just think we actually have more value than ever, given the circumstances that we've got. So it's like, you know, we like stable clients who buy stable limits, or even more limits, because, you know, we always like people, and it's equitable where there's an alignment of interest. So I do think whilst there's a lot of challenges, us as Lloyd's, as well as the wider marketplace, can sit there and meet clients' needs, and that's what's important. And as we come out of business as usual, and we start going back to the way we used to do stuff, we could be on the front foot and provide a quality product and defend against an aggressive plaintiff's bar to try and achieve the right results for everyone concerned.
I think that's well said. All I'd say is, you know, kids say to me, "What do you do?" Well, I'm an underwriter. What's an underwriter? Well, the object of the exercise is to have more premium than claims at the end of the year, such that you remain in business. It's the fortunes of the many and the losses of the few. So the point is, if you are expecting more losses and they're costing more, you've got to have a sufficiently priced book of business that is going to sustain that level of loss experience and loss quantum. And that is the challenge for the excess liability market. You know, if there are too many losses and they're costing too much, sadly, it's, you know, it's hard to see that pricing's ever going to reduce. Anyway, that was here ended the lesson.
That's a happy note to end on. So.
What do you expect me to say, Warpath?
Exactly.
I wouldn't agree with that one.
We're
But
going to be busy for a while, basically, Matt. We're not going to go away anytime soon.
Yeah.
Back to you, Pat. I see you.
Yeah. Well done, Alex.
Background.
Thanks.
Thanks, Alex. And let me just say, a very big thank you to you, Paul and Matt, for a fascinating discussion and for kicking off our special 3-day series on casualty. And that will do it for us today. Be sure to join us tomorrow at the same time, 11 Eastern, for part 2 of our series, when we will be joined by Jillian Frank and Nick Wood of Canopius Group, who will share their insights into claims and social inflation, providing transparency into what carriers are considering, how they are responding, and what it means for insureds. As our session ends today, please do take a moment to answer the survey questions that will pop up in your browser, as we greatly value your feedback. And you can also drop us a note anytime at usevents@lloyds.com. So until tomorrow, let's keep staying connected. Take care and have a great rest of your day.
Everyone. Thanks.
Thank you.
Cheers.
Bye-bye.
Thanks.